Hey there! So you want to invest and get rich. Great! But now your portfolio is red, minus. Every time you check, it's worse. The news screams about crashes, recessions, and corrections. But what does it all mean? Should you panic, buy more, sell everything, or just close the app and cry? Before making any moves, remember that many market crashes in history have created new millionaires. This might be your chance to become rich. What? Really? Then how do you do it? Before we start, let's first understand, why do stock markets crash? Is this normal or should you be worried? How do you survive a crash? And most importantly, how do some profit while others lose everything? In this video, we'll cover everything you need to know about stock market crashes. Let's get started. Section 1. Why do stock markets crash? To understand stock market crashes, we first need to know why they happen. A crash is when the stock market suddenly drops fast, meaning many stocks fall sharply. This usually happens for 3 reasons: bubble bursts, bad economy, and black swan events. Let's break them down. The first is bubble bursts. You've probably heard the word bubble thrown around in the stock market. But what does it actually mean? A bubble happens when stock prices go way higher than they should, usually because of hype, not real business growth. And when investors realize this, they all sell the stocks, and the stock's prices drop hard. A real-world example is the dot-com bubble in the early 2000s. The internet was the new hype, and investors threw money at any company with .com in its name, even if it had no profits and no real business model. At its peak, over 400 internet companies went public. And the Nasdaq, the tech-heavy index prices, jumped by over 800% in total. But when people realized most of these companies were not making money, the investors sell all their stocks, and the bubble popped. The Nasdaq, a tech-heavy stock index, crashed nearly 80%, wiping out trillions of dollars in market value, and needed 15 years to return to its original price before the bubble. That's how bubbles work. Hype inflates prices, reality pops them. Then, the second reason is a bad economy and certain policies. Bad economic condition, like when inflation is too high, makes food and rent more expensive. People cut back on spending, which means businesses make fewer sales. When a company earns less, investors expect lower profits in the future, so they sell the stock and the price goes down. If this continues, it can lead to a recession when the entire economy shrinks. Production slows down, spending drops, and investors panic, causing the stock market to fall even further. That's why recessions are often linked to stock market crashes. Sometimes, certain policies can also cause crashes. When the inflation rate is too high, the central bank raises interest rates to slow down the inflation, making loans more expensive. Businesses that need money are struggling, so they cut production. People start saving money and spend less, which spreads panic and pushes stocks down even more. And that's why every time this guy announces interest rate changes, investors are worried. If rates go up, loans get more expensive for businesses, and stocks usually drop. If rates are cut, loans get cheaper, businesses have more money, and stocks usually rise. The third is black swan events. Black swan is just another name of unexpected disasters, like wars, pandemics, terrorist attacks, financial scandals, and more. These kinds of shocks make people worry about the economy, which makes people get scared and sell their stocks as fast as possible, causing prices to crash. A real example is the 2020 COVID-19 crash. Nobody saw the pandemic coming, and within weeks, global markets fell by over 30% because investors panicked about businesses shutting down and the world economy collapsing. So these 3 are the main reasons behind a stock market crash. Of course, there are other factors too, like too much leverage, margin calls, or even herd behavior. But we won't go deep into those, since I want to keep this video simple. Now, we know why stock markets crash. But the real question is this normal or should you be worried? Let's find out in the next section. Section 2. Are stock market crashes normal? Yes, stock market crashes are normal. The stock market doesn't just go up all the time, it moves in cycles with ups and downs. If you're investing for the long term, you need to understand that crashes are part of the game. In fact, for traders, these ups and downs are opportunities for them to buy low and sell high. Because if stocks only went up, everyone would just invest long-term instead of trading. Believe it or not, history shows that the market follows a repeated pattern of market downturns. The first is pullbacks, when stock prices fall around 5 to 10%. This happens almost every year and is considered normal market movement. The second is corrections, when stock prices drop 10 to 20%. As the name suggests, corrections happen when investors realize that the stock prices are overpriced and corrected back to their fair prices, usually every 1 to 2 years. The third is bear markets, when stock prices fall around 20 to 40%. This usually happens every 5 to 6 years, often due to economic slowdowns or rising interest rates, because the economy isn't always good like a fairy tale. And the last is crashes, when stock prices drop 40% or more. These happen about once every 10 to 20 years, usually due to black swan events like financial crisis or global disasters. So this is the table of differences. Feel free to take a screenshot. History has proven again and again that the market bounces back and even gets stronger after every crash. In 1973, the oil embargo crash sent markets down by nearly 50%, and it took about 7 to 10 years to fully recover. During Black Monday in 1987, the New York Stock Exchange crashed 22% in one day, but recovered in 2 years. During the 2008 financial crisis, the S&P 500 crashed nearly 50%, but eventually recovered in 4 years. During the 2020 COVID-19 crash, the New York Stock Exchange dropped 30% in just 5 weeks, but fully recovered in 4 months. Different crashes, but the same pattern. Market falls and come back even stronger. So, who lost money? Those who panicked and sold. And who made money? Those who stayed calm and held strong stocks. But some people still panic and say historical performance doesn't guarantee future results. What if this time the crash is different and never recover? How do we know? That's not completely wrong, but there are indicators to help you know when a crash is just part of the cycle and when you should actually be worried. Crashes are normal if you see the businesses are still operating, people still can spend and do leisure, and some actions have been made to stabilize things. Then the crashes most likely will recover. But this mainly applies to big, stable economies like the US. In smaller or unstable countries, crashes can take longer or recover differently. So you need to understand your country's condition. You should only start to worry if the entire economy breaks down. Like if businesses keep failing, banks go bankrupt, people can't access their money, and the country defaulted on its debt. Those situations are extremely rare, but if they happen, then yeah, that's the kind of crash that's much harder to bounce back from. Now you understand which crashes are normal and which ones are not. So your next question is, how to survive during stock market crashes? Well, let's find out in the next section. Section 3. How to profit from a stock market crash. A stock market crash might seem like the worst time to invest. You might be wondering, how do you even survive it? But here's the surprising part. Many people actually make huge profits during a crash. For smart investors, a market crash is one of the best opportunities to build long-term wealth. Like Warren Buffett said, be greedy when others are fearful. So how do you actually do that? Let's go through some common mistakes and what you should do instead if you want to profit during a crash. The first mistake is panic selling. When people see their portfolio turning red, their first instinct is to sell everything before it drops more. But here's the truth. You haven't lost money unless you sell. A stock might be down, but it still has a chance to recover. But if you sell at a loss, that loss becomes real. If you invested in strong, profitable companies, there's usually no reason to sell just because the market is down. Instead of panic selling, stay calm, stay informed, and focus on the long term. The second mistake is trying to time the bottom. Some investors try to predict the lowest point of a crash and wait for the perfect moment to buy. But the problem is, how accurate can you predict the lowest point? Many people wait too long and miss the lowest point, while others buy too soon, thinking prices won't drop further, only to see them fall more. Instead of guessing, a better strategy is dollar cost averaging, or DCA. DCA means investing a fixed amount regularly. So you buy more when prices are low and less when prices are high. This removes the stress of trying to time the market, and as long as you buy strong, profitable companies, DCA should be a worry-free approach, as long as you're confident in the company's long-term strength. The third mistake is buying bad stocks just because they're cheap. If you noticed, I keep emphasizing buying strong, good, and profitable companies. Why? When stock prices crash, it's tempting to buy anything that looks like a bargain. But not all companies recover. Some businesses fail completely, and their stocks never bounce back. That's why it's so important to focus on strong, profitable companies. Those with low debt, solid earnings, history of surviving tough times, and good prospects. During a crash, great companies become cheap not because they're bad, but because everyone's panicking. For example, before the 2008 financial crisis, Amazon stock was at around $90 per share. If you had $1,000, you could only buy 11 shares. When the crash happened, Amazon dropped below $40 per share. Now, with that same $1,000, you could have bought 25 shares instead. If you had done your research and believed Amazon was a strong, profitable company with good future prospects, you could have bought it at that price. A few years later, Amazon rebounded and skyrocketed, reaching over $3,000 per share by 2021. That's over 8,000% growth. That means those 25 shares from the crash would have been worth over $75,000. And if you're interested in investing, Moomoo is a good platform to try. Click the link below to get up to 15 free stocks when you deposit and enjoy 8.1% APY on idle cash. Then the fourth mistake is not diversifying. Some investors put all their money into one stock or sector, thinking it's a sure bet. But when a crash happens, some industries fall harder than others. Smart investors spread their investments across different sectors like tech, healthcare, consumer goods, and utilities, so that if one area crashes, others can help balance the losses. Some even diversify into non-stocks like bonds, commodities, or international stocks to protect against stock market crashes. If picking individual stocks sounds hard, then you can consider buying funds like ETFs or index funds, which make it easier by automatically spreading your investment across multiple stocks. This way, you don't have to pick individual companies yourself. If you want to understand more about funds, check out my other video about ETFs, mutual funds, and index funds, link in the description. The last mistake is FOMO, or fear of missing out. When panic spreads, people blindly follow what others are doing. If everyone is selling, they sell. If the news is predicting doom, they believe it. But even legendary investors like Benjamin Graham and Peter Lynch have said that even Wall Street professionals cannot predict the market perfectly. So make sure you understand what you're buying by doing your own research. And if you're still unsure, it's totally okay to speak to a financial advisor. But either way, you should always understand what you're investing in. Never blindly follow anyone, not even the pros. Like Warren Buffett says, never invest in something you don't understand. Now those are the common mistakes and smart actions for beginners. But there's one more strategy that some professionals use to profit from a crash, which is called short selling. It's when you bet that a stock's price will drop. For example, imagine your friend owns a stock worth $100. You borrow it, sell it for $100, and wait. If the price drops to $70, you buy it back, return it to your friend, and keep the $30 difference. But if the stock rises instead, say to $120, you'd have to buy it back at a loss. Some legendary investors made billions shorting the market, but it's extremely risky. That said, I'm only explaining it for knowledge. I don't recommend it, especially if you don't fully understand how it works. So in conclusion, a stock market crash feels scary, but it's just part of the cycle. Historically, the US stock market has always recovered and even reached new highs after crashes. While no one can predict the future, past patterns show signs that recovery is likely unless the economy completely collapses. The key to surviving and profiting from a crash is staying calm, avoiding panic selling, doing thorough research, and buying quality stocks at a discount. Panic sellers lose, but smart investors turn crashes into their biggest wins. So when the next crash happens, don't fear it, but be ready. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.